You're entering the future-ready CNBC-TV18 EBIX Cash Studio.
Hello and welcome to CNBC TV18's EBIX Cash Studio. You're watching Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Now, passive funds are really coming of age in India. There's always this debate between active investing and passive investing. What we do know is that a lot of AMCs are launching new funds on this side. In fact, this year itself, we've seen several NFOs. And many of these funds are going beyond the plain vanilla Nifty-based or Sensex-based investing models. On this episode, we will focus on helping you develop a more evolved and thought-out passive strategy for your mutual fund portfolio and ask the basic question, should you complicate it with a lot of the newer strategies or should you just keep it simple? Well, joining me now to answer some of those questions is Feroze Azeez, Deputy CEO of Anand Rathi Wealth Management. Feroze, always a pleasure to have you on the shows. You know, it's really interesting how quickly the Indian retail investor is learning. Because a lot of the feedback that we also get on social media, for instance, people are asking about low-cost options, asking why should they bother with too much of, active in their portfolio if passive funds can be a good, cost-effective option. So your first opening thoughts on what you really think about passive investing as a whole.
Thanks, Surabhi. Always nice to be on your Money Money show. Of course, passive is gaining momentum, like you rightly highlighted. It has grown as an industry, not just in terms of the number of products which are being offered from 52 to 111 today only on the equity side. That's a very large jump, almost a 17% growth in the number of schemes. The startling bit is that there was only 21,000 crores which was there, which is now ballooned to almost 3 plus crores in the passive strategy. So it's a very, very important point to be highlighted to the viewer to look at passive. That's point one. Point two, like you said, should passive form a part of your strategy? Is cost the only variable to be looked at? To my mind, if you break down passive into smaller components, then it'll be very easy to comprehend whether which part of the passive needs to form a part of your portfolio. Are all deserving a merit to infuse into your portfolio? The answer is no. Do all of them require to be ignored? The answer is no. So the answer lies somewhere in the middle. Because when you buy things, not just services like fund management, cost is one of the variables, not the only variable. So there are some places where there's value and a cost efficiency. If that talmeil can be found out and that balance, as we call it, santulan, if that could be got, then it's a brilliant one.
Okay, absolutely. Well, just in case you're new to this world, we didn't actually give you the definition. So here it is. The basic concept of passive investing is that there is no fund manager involved. It's basically going to be a mutual fund that will mirror an underlying index. So my question, Feroze, is this. Most people understand the Nifty 50 and the Sensex 30 and funds that are simply going to exactly mirror the same set of stocks, the same constituents. So, is it the best to simply look at just these category of passive funds and how much money should you allocate to them in your overall portfolio?
I think these broader market indices like Sensex and Nifty, to my mind, it's not a very good idea to go the passive way for this particular segment of your allocation. Like, for example, the schemes which we recommended or at least recommended on the shows in 1st January on CNBC TV18 itself has outperformed Nifty and Sensex by 7-8% in this calendar year, those 10 schemes, with risk levels 90%, not even 100% or more of the Nifty risk. So you're taking 10% lesser risk and generating 6, 7, 8% extra, which is the cost you will save in 10, 15 years by going the passive way. So you are rightly highlighting, Surabhi, nothing more important than this point, that you should not go the passive way for Sensex and Nifty, but there is value which is emerging as the industry progresses and widens the offering on this space. But for Sensex and Nifty, I would stay away. But unfortunately, 82% of the assets in the passive categories in this segment where there's a lot of value which is being missed because of the active management.
Feroze, you're making a very interesting point, and explain that a little more to our viewers, because common logic would say that the Nifty 50 stocks and companies are the most well-known companies and widely researched companies. So typically, like we see in the US market, when it's these large cap stocks, that's where there's not much left to be discovered. So traditional wisdom will tell us that for this category of investing, your large cap blue chip investing, maybe you can have a passive fund, a Nifty fund or a Sensex fund. But you're saying that's not the kind of passive fund that's had the best return, if I get you right.
See, passive fund, going the passive way is like 100% certainty to saying I don't want any value beyond Nifty. There are about 13 large cap funds who have finished 3 years and are above 3,000 crores of assets, or at least 2,000 crores of assets. Out of which have all the 13 generated an extra return after cost? The answer is no. Have 8 of them, 9 of them generated extra return? Then the index, the answer is yes. So if you have a very microscopic view and ready to put in effort, or your advisor is ready to put in effort, he will be able to get you some alpha of 1, 2, 3% on the large cap category. But the beauty is active management is broken down into 10 or 11 different segments by SEBI. So you have the large cap category, you have the large and mid, the flexi cap. So giving them the freedom to sometimes have 8-10% in mid cap, even to the large cap guy, helps you generate that 1-2% extra over long periods of time, and that becomes a substantive amount, almost equal to your capital in 10 years. If you're speaking about a lakh rupee investment, you might just get 1 lakh rupee extra in 10 years just for the alpha, if there was 3.5% alpha possible.
Now, Feroze, tell us about taking global exposure. I think it's become very clear over the last year or two that retail investors want a little piece of the global action as well. The question always is active fund, like I remember the Franklin US feeder fund, which is an actively managed fund. Or should you look at the passive way? I mean, there are funds these days which are based on maybe the NASDAQ 100, the S&P 500. So help us out here. What to do?
Surabhi, I'm always impressed with the way your questions direct to value creation for the viewer. You're absolutely right. In the global space, which is a far developed world from investing standpoint than India is, you may want to go the passive way. You may not want to go the active way, because then you have 2 layers of fund management, or at least cost being layered up in terms of the domestic feeder fund and the global fund as well. So a passive managed global fund exposure also ensures lower cost, but to top it all, it also ensures diversity in the exposure, which is very critical because the world is a very large space. So I would say Motilal Oswal's S&P 500, for example, I'm just for illustrative purposes, I'm using this fund, which only does not invest in technology-based stocks or industrial stocks, but gives you the full gamut of a reasonable representation of the US largest economy's largest index. So that I don't think requires active management. So passive global strategy is definitely a winner, point 1. Point 2, choose an index which gives you diversification, because that's the sole purpose of stepping out of the Indian geography, which is growing reasonably well and is expected to do so for the next 4-5 years. If I'm stepping out, then it is diversification. Then I better well do it well if I'm getting diversification. So that's my take on the global bit. One thing particularly really impresses me is the latest launch, apart from the Nippon Hang Seng Fund, which invests in a Hang Seng as an index, which has not done too well, but in the future has potential. Lastly, this HDFC Developed Market Index Fund, which is just launched for an NFO, gives you exposure to 14 different currencies, 1,500 different stocks. You might be able to get huge diversification if you use the passive strategy on the globe side.
Wow, 14 different currencies. That could lead to a separate conversation altogether for another day with Feroze. But, all this while we've been talking only equities. And Feroze, the fact is that it's not just equities, right? Now you have indices in the bond market, and there are funds coming out on those indices as well. I mean, I remember the Bharat 22, the Bharat Bond ETF, which Edelweiss did. That was our first sort of experiment with an index fund or an ETF based on a bond index. There are more AMCs. ICICI is doing something on it. Aditya Birla is doing something on it. So tell us more about these products and whether they make sense.
Yes, Surabhi, they definitely make sense. Again, a very important point, because in the debt side, your return is not 14, 15, 13, 12%. So anything you save on the debt side, out of your 6% income, if you're able to save 40 paisa, 30 paisa, or even 0.5%, then you're increasing your return potential by 8-10% of the total income. So you have to be more cost sensitive on the debt side than the equity side. So point one. So passive on the debt side is meritorious because value is lesser. So cost becomes a key driver of decision making. The second point is because there is development in the product side, like you said, Edelweiss began the journey by creating an exchange traded fund on the debt side, which did very well. Also has a 6.8% yield to be locked in for the next 8-9 years. If I can lock in 6.8, get tax efficiency, it's so much better than a fixed deposit. I would move my fixed deposit as of yesterday to a passively managed debt fund. Coming to your point of Aditya Birla and ICICI launching NFOs, there are two interesting ones which only invest their money is in PSU companies, which are government-backed or state development loans. 50-50, 40-60, which can give you 5.86% locked-in post-expense return if held till 2026, 5 to 6 year papers. So it's very good, and you still have the liquidity on the exchange. It's of course time will tell what kind of liquidity, but at least the Edelweiss Bharat Bond ETF has reasonable liquidity on the exchange for a person to enter and exit.
Okay, got that. Thank you very much. With that, we are out of time on this edition of Money, Money, Money. Thanks for watching. Keep your feedback coming. News and updates continue.